Alright, this is part 4, merchandising, selling stuff instead of services. The accounting cycle that we've been talking about, where we record business journal entries, post them, and then prepare an adjusted trial balance. We record adjusting journal entries and post those, and then prepare an adjusted trial balance. And then we can prepare financial statements, record closing entries, post those entries, and start over, is the same for service businesses as it is for merchandising businesses. So the accounting cycle is the accounting cycle. It doesn't really matter what kind of business you're talking about. But when you look at a business that is different, service businesses are different than merchandising. Merchandising businesses are different than manufacturing businesses. When we have different kinds of businesses, we're going to have different things that happen in this cycle. The overall cycle stays the same, but what actually happens within the cycle, okay, is going to be a little bit different. So, our rules for debits and credits, the temporary accounts, permanent accounts, all of that stuff stays the same. Okay, we're not really changing anything in that regard. So we can still follow the rules that we've been learning and using. But when we have a merchandising business, their purpose is a little different than a service business. For example, our fake company here, Carl's Canoes. Let's say that Carl decides that instead of just renting out canoes for people to enjoy a spin out on the lake, he's going to sell something. Okay? He's going to purchase from a vendor or a supplier. He is going to purchase oars. Okay? And so he wants to sell these oars to people that come to his business. Eventually he thinks he might sell canoes also. But he buys some oars. Now, he has this product that he wants to sell to people to make money. And so we call this inventory. Okay? It's classified as a current asset on the balance sheet. Okay? So customers will then come and buy these oars from him, or at least that's the plan. And when Carl sells this inventory, okay, to his customers, he is going to have to expense the cost of that inventory. And the account we use to expense the cost of that inventory is called cost of goods sold. Now, it's a little bit of a unique expense account because it doesn't say the word expense. Okay? So hopefully his customers will pay him more, right, than he paid for these oars. And that's how he's going to make a profit. That's how he hopes to make some money. Okay? So the operating cycles, the way the businesses work, is quite different, right? A service business starts with cash, and then they go out and they provide services. You know, they use the money to pay employees or buy supplies or whatever. They go out and provide services, and then they hope to collect cash from their customers, step number 3, and then the cycle starts over again. Okay? But a merchandising business is a little bit different. Okay? You're going to start with cash. You're going to use the cash to buy inventory. Like in the case of Carl, he's going to buy oars, paddles, or whatever you want to call them. Then he's going to attempt to sell those paddles or oars, and then he's going to have to collect the cash from his customers, which then can start the cycle over again. Now, this is kind of a simplistic look at the cycle, but that's generally how a merchandising business works. A merchandising business does not make the stuff that it sells. It simply buys it from one entity and sells it to another. Now, there are some other things that can happen in a merchandising business. When he buys inventory, he buys these paddles or oars. You know, they might come, they could be damaged, or maybe they're not what he ordered, and then he can send them back. So we got to deal with purchase returns. Sometimes businesses will give incentives for companies to pay early, and those are called discounts. So we have to potentially deal with what a purchase discount looks like. And then after he sells these oars, you know, his customers, like many of us have done in the past, take stuff back that we bought. Okay? Okay? And in that case, for the business, those are called sales returns. And then he even may give some discounts to people in order to entice them to pay more quickly. So we could deal with some sales discounts. So moving from a service business to a merchandising business creates some new accounting things we got to do, or we might potentially run into. So we're going to take a look at Carl's business here for the month of June and see if we can't journalize the things that happen. We have transactions here, N through Y, okay, and we have our journal and the big three questions. What accounts are affected? Did they go up or down? And does that mean debit or credit? Okay, so we're going to start with letter N. Okay, Carl purchases 16 paddles for $30 each cash. Well, what's going to happen here? Carl's asset inventory is going to go up, and that's 16 paddles, $30 a piece. So $480 purchase. He purchased them for cash, so his cash is going to go down by $480. Letter O. Carl sells 10 paddles to Joe Rower for $50 each in cash. So he sells 10 paddles to Joe, and he charges $50 a piece for them. Okay, what's going to happen here? Well, he's going to get some cash, right? So cash is going to go up. Cash is going to go up 10 paddles, $50 a piece. Cash goes up $500. What do we credit? Well, if we remember the definition of revenue, right? Definition of revenue is the amount charged to customers for products or services. So in this case, he gets to record sales revenue of $500. Okay? But that's not the only thing that happens here. Okay? It's not the only thing that happens. Carl no longer has the inventory. He gave it to Joe. And so we need to do something with that. Anytime an asset is used up, you expense the benefits of the asset. So we know, first of all, that inventory is going to go down. Now, he sold 10 paddles, and those 10 paddles had a cost to Carl of $30 a piece. So his inventory goes down by $300. And we have to expense this $300. And we use that account, cost of goods sold. So when we record the sale of merchandise, we actually have 4 things to put down. Okay. Letter P. Carl sells the remaining 6 paddles to Sam Fisher for $55 each on account, with terms 210 net 30. So we'll explain that in a second. He sells the remaining 6 paddles for $55 each on account, which means Sam Fisher has not paid for them yet. So accounts receivable goes up. Carl is owed money. How much money? Well, 6 paddles and $55 a piece. $330. He has earned sales revenue because he has fulfilled his obligation to the customer. Okay? He has provided these paddles. Okay? What else has happened? Well, his inventory has gone down. Inventory goes down by 6 paddles and the $30 that he paid for them, $180. He has to expense those paddles, $180. Okay, so the first one, O, right, is a sale for cash. And the second one, P, is a sale on account. Now, these terms, 210 net 30 that we see over here, okay, 210 net 30 means that if Carl pays within 10 days, he will get a 2% discount. And anything he doesn't pay within 10 days, the net amount, is due within 30 days. So Carl has 30 days to pay, but if he pays within 10, he can get a 2% discount. Okay, so we'll get back to that later. Letter Q. Carl collects $400 of its accounts receivable. So Carl's going to get cash, right? 400, and accounts receivable is going to go down by 400. Okay, letter R. Carl pays off 100 of its accounts payable. So Carl owes money to people, he pays it off. His liability goes down, so we debit accounts payable for 100, and his cash goes down, so we credit cash for 100. Letter S. Sam Fisher, who purchased 6 paddles from us back in letter P, Sam Fisher returns 2 of the paddles previously purchased for $55 each. So he returns 2 of the paddles he purchased. We don't know why. It's not a big deal why. We just need to know what to do with this. Okay? So what's going to happen here? Well, if he returns 2 paddles, he doesn't have to pay for those. Did he pay for them already? No, he didn't pay for them already. So what do we do here? Okay, we record what is called sales returns and allowances. Okay, which is for 2 paddles for 55. Okay, so we could write this in here. 2 times 55, $110, and his accounts receivable, the amount we have on our books as to what he owes us, goes down, 110. Okay. Now, there's something unique here about this account, sales returns and allowances, okay, that we need to talk about. So, this is a new account classification for us. Okay, we know what contra assets are. We looked at those in a previous video. Contra asset accounts, like accumulated depreciation, are assets that have a credit balance, an offset, or are contra to a particular asset. We also have what are called contra revenue accounts. Okay? Contra revenue accounts, like sales returns and allowances, and also sales discounts, which we'll get to in a minute, are revenue accounts that have a debit balance and offset or are contra to a company's revenue. So if we go back to the journal here, when we originally recorded this sale, we recorded the sale as revenue. But when he returns these, okay, we really didn't capture that revenue, okay, because he's not going to pay for those, and he gave them back to us. So we use this account, sales returns and allowances, as a contra revenue account to show that we are not going to be expecting to collect that $110. Okay. Now you could simply debit sales revenue here. It wouldn't be a violation of anything. It would reduce your revenue. Okay. But the sales returns and allowances account, if we use it, okay, that will help us track how much we have in sales returns. Okay. So, moving forward, we've recorded the fact that he doesn't owe us the money anymore, but he also gave us the stuff back. So we're going to put back into inventory those 2 paddles at what we originally paid for them, which was $30. Now, if we do that, okay, we are also going to remove from cost of goods sold, okay, those 2 paddles for the $30 that we paid for them. Because what are we going to try to do again now that we have these paddles back? We're going to try to sell them again. And if we sell them again, we will have to expense them again. And we don't want to expense them 2 times. Okay, that wouldn't work. So, we expensed them when we sold them the first time, but since he returned it, we got to take that expense away. When we turn around and sell them a second time, then we can expense them again. Letter T. Carl collects cash from Sam Fisher for the amount owed within the discount period. Alright, so we gave him 10 days to pay us. Okay, I gave him 10 days to pay us and get a 2% discount. So he paid within these 10 days, so he's going to get a 2% discount. First of all, we know he doesn't owe us the money anymore. So accounts receivable is going to go down. How much? Well, Sam started out owing us $330, but because he returned those, we took out $110. So he owed us $220. He's going to pay us cash, so our cash is going to go up. But how much? He gets a 2% discount, which means our cash is going to go up only by 98% of the balance, because he is going to write us a check, not for the full $220, but for 98% of that, because of the 2% discount. So we're going to get $216 in cash. Now, if you see this journal entry right now, we know there's a problem because it doesn't balance, right? We need a $4 debit to balance this entry. And we are going to put that in the account sales discounts, which again is a contra revenue account. Contra revenue accounts, right, are ones that are going to offset revenue. And we'll see what that looks like in a few minutes. Okay. Letter U. Okay. Record the adjustment for prepaid rent. Okay. Carl paid for May and June rent during April. $250 per month. Okay. So in April he paid for May and June rent. Now it is June. We've got to adjust. $250 a month. So what are we going to do? We're going to record rent expense for $250, and we're going to credit prepaid rent for $250. There's our adjusting entry, deferral adjustment. Letter V. At the end of June, Carl counted his remaining supplies and determined that $115 of supplies were still on hand. Okay, $115 of supplies were still on hand. So we need to know how much he had in supplies to begin with. Okay, how much did he have in supplies to begin with? Well, if we go back to our ledger, okay, as you'll see, I've filled this in already, but if we go to our ledger and we look for the supplies, okay, account, well, where did I put it? He had 130 to start with, right here in the middle. Okay, 130 to start with. So if he had 130 to start with, okay, and we now say that he has 115 left, okay, we are going to expense through supplies expense the $15, okay, that he's used up. So we credit supplies for 15. Okay. Letter W, record depreciation for the month. Okay. Depreciation, right, as we looked at in chapter 4, okay, and we recorded in the previous video, okay, depreciation expense $4. Okay, we had determined it was $4, okay, by looking at $50 a month, right, and then we broke it down by month, or $50 per year, we broke it down by month, and depreciation of the canoes, the equipment, right, depreciation expense is $4, and we record that in accumulated depreciation for $4. Okay. Letter X. Record the accrual of interest for the quarter ended June 30th. Carl owes the bank $8. Interest will be paid when the loan is repaid at the end of August. So Carl owes the bank $8. We're going to put that in a liability account called interest payable because he owes $8. And we get to expense that interest through an account we call interest expense, $8. Okay. And then the last one here, letter Y. Record the accrual of income taxes for the month. Carl owes $6. So, he owes for income taxes. We're going to credit income taxes payable. Okay, that is our liability. Shows that we owe, if I can spell, we owe for income taxes, $6. And we've incurred income tax expense, $6. Okay, so these entries, okay, are the merchandising entries for Carl for the period. Now, there's other things that could happen, okay, but these are a good general overview. There's a couple things we didn't do, but that's okay. I'm going to provide some other things in an attachment, okay, that'll be able to walk you through some other kinds of transactions. But for now, for illustrative purposes, okay, we have our journal entries. So as you can see here, I put the journal in, okay, and I've also put the general ledger in. So you can see where we started with these accounts, okay, the beginning balances if they had any, and then the ending balances after we post all of these entries. Okay, so these are the first few, N through T, okay, and then U through Y, okay, the remaining. So we go through the journal, right? We record all our journal entries, and then we post them into the T accounts. That way we can find the balances in our ledger. Once we've done that, okay, and we've done our adjustments, we can prepare the financial statements. So this is the kind of financial statement we've been putting together. It is called a single step income statement. All we do is take revenues and subtract expenses, find the difference, which we call net income or profit. But when we get to a merchandising business, we often put together a statement that looks quite a bit different, okay? Provides us with more information, and that is called a multi-step or multiple step income statement. And for the purposes of this video, we're going to look at the first 3 sections. Okay, there are a total possible, okay, of 6 sections, but we're not going to get into the other sections in this series of videos. So here's what a multi-step income statement looks like. We start with revenues, which in the case of a merchandising business we often refer to as sales. We take out the 2 contra revenue accounts, sales returns and allowances and sales discounts, and that gives us what we call net sales. Okay, the difference between our original sales and how much we actually expect to collect, or the amount we think we could collect. Okay, then we say, well, we sold stuff for $716. That stuff cost us, cost of goods sold, $420. Okay, and the gross profit, the difference between what we sold it for and what we paid for it, is $296. Now, gross profit. Again, when we look at accounting and we use these words gross and net, gross does not mean nasty and disgusting and smelly and stinky, right? Gross means before stuff is taken out. Net means after stuff has been taken out. Okay? So gross profit means the profit we earn by selling stuff for more than we paid for it. Out of that profit, we have to cover all of our expenses. So the next section here is the operating expenses. Rent expense, supplies expense, and depreciation expense. That totals $269. And so our income from operations is $27. Our profit from operating the business is $27. Now that's not net income, because we have some other stuff. We have interest expense. That's a cost we incur because we borrowed money, not from our operations. And then we have income taxes, which again is a cost we've incurred, but not because of our operations. That's because the government wants to take some of our money. And so we have income from operations, income before taxes, and then net income at the bottom. And so if you look at this, there are three income numbers: income from operations, income before income taxes, and net income. And those highlight the three sections that the multi-step income statement has. The operating section ends in the income from operations. The non-operating section ends in income before taxes. And then the third section is income taxes, which ultimately then leads to our net income. So these are the three sections that we'll be using from now on as we put together income statements. So what does it look like overall? There's our income statement, multi-step. Our retained earnings statement has not changed. It is still the same. And our balance sheet has only changed a little. We've added the asset inventory. Right? A service business is not going to have inventory because they don't have products that they sell in order to make money. They provide services. So when we buy these products to sell, they go on our balance sheet as inventory. When we sell those products to our customers, we expense them. The cost of those we expense through cost of goods sold. So those two accounts are linked together, just like supplies is linked to supplies expense, right? Prepaid rent is linked to rent expense, and equipment is linked to depreciation expense. Anytime we use up the benefits of an asset, we are going to expense the cost. So, summary. Merchandising, the steps in the accounting cycle are the same as a service business. Merchandising businesses have to account for inventory, though. Inventory are the products a business sells in order to make a profit. In a merchandising business, the company does not produce these products, but simply purchases them from another company. Cost of goods sold, the benefits of an asset are used up. The cost of the asset must be expensed. So like we said before, supplies to supplies expense, equipment to depreciation expense, inventory to cost of goods sold. Now again, cost of goods sold is a weird expense account because it doesn't say expense like all the other ones do, but it's still an expense account. And the multi-step income statement. Merchandising businesses often prepare what is called the multi-step income statement. It generally has three sections: the operating, non-operating, and income tax. So, as always, remember,